So I get this question all the time. Brad, what is the best superannuation fund? And it's a difficult question to answer because it's a bit like asking, what is the best car? Do you want a fast car? Do you want a reliable car? Do you want a petrol car? Do you want an electric car? Are you planning on going off-roading? Is safety a big factor for you? How many kids do you have? So just like a car, the best super fund for you is going to depend on your situation and what your intentions are. And in today's video, I want to give you the key components of super funds that you need to consider so you can answer this question for yourself. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we're talking about super funds. When judging what the best superannuation fund is for you, you need to consider the components that make up the final retirement balance. Because at the end of the day, the best super fund is going to be the one that gives you the most money at retirement. And when you're considering this question, there's a few components that you need to take into consideration, and they are as follows. So your balance at retirement is going to be a function of your starting balance, plus any contributions, plus your investment returns, minus any fees, minus any insurance premiums, and minus any tax. So kicking things off with the starting balance. Now, this is obviously the money that you already have within your superannuation fund. And so unless you have a DeLorean time machine, there's not much that you can do about your starting balance. So let's forget this one and move on. Next up, we have contributions. And typically most superannuation funds out there will accept contributions. And really it's incumbent upon you to make sure that the contributions you're putting into your super is gonna give you a reasonable benefit at retirement. However, there are some instances where you need to take into consideration contributions when picking which super fund you use. Firstly, there are some employers out there with corporate super plans. Now, the super plan is normally just a division of a large industry fund, but sometimes in your employment agreement, it will state that you get additional contributions if you pay into the corporate plan. So if in your employment agreement, it states that you get additional employer contributions above the 9.5 superannuation guaranteed contribution by using a particular super fund, then 99% of the time it's going to be worthwhile you using that super fund. It would have to be a pretty dodgy, pretty bad super fund for you to say no to free contributions. Also, with regards to contributions, there's the occasional untaxed superannuation funds out there. Gesby Weststate Super is a prime example of this and probably one of the more common ones. But with an untaxed fund, they do have some unique advantages when it comes to contributions over a typical tax super fund. And so in a tax fund, you're subject to an annual concessional contributions cap limit of $25,000 per financial year in the current year, and that's actually increasing to $27,500 next financial year. But an untaxed superannuation fund isn't subject to those standard cap limits. It has an untaxed plan cap. The untaxed plan cap is currently at $1,565,000 in the current financial year, and this is increasing to $1,615,000 next financial year. This means that you're not subject to the standard yearly cap limit that comes with a typical superannuation fund. Instead, you have this untaxed plan cap, and you can use that cap limit at any time. You can put as much money in at any time as you want up to that cap limit amount. Now, for high income earners, this can be a really good retirement strategy to help you boost your super and save a lot of tax. The fund that you put your money with is going to dictate what you can invest in. So before putting your money with any superannuation fund, have a little think about what you want to invest or how you want to invest your money. If you're the type of person that doesn't know much about investing, doesn't really care about investing, and just wants something very simple, then normally an industry super fund is going to be a good option for you. Industry funds will typically give you a list of pre-mixed options that you can pick, and when you pick the option, your money gets pooled with other members within that fund. So this is a really hands-off type approach to managing your super that really works for a lot of people. However, if you want to take a more hands-on or bespoke approach to managing your superannuation, then there are funds out there that cater for that too. So there's certain funds that are going to give you access to ASX listed securities, international listed securities, ETFs, LICs, managed funds, M funds, LITs, term deposits, annuities, just about a lot of different options. I won't say everything, but a lot of options. And so this gives you the opportunity to really tailor your own portfolio to suit your particular needs. Now, obviously, the superannuation trustee does put limits on the amount that you can invest in any one single asset, but if you think about it, if you're exceeding those limits, then you probably should take a step back and wonder if you're doing the right thing anyway. And of course, there are self-managed super funds or SMSFs. And these are going to give you even further flexibility because you can just about invest in anything you like, and they open up asset classes like physical property and crypto. And provided that the investment is done at arm's length and provided that you follow all of the rules of the fund, like the in-house asset test, then it really is an open slather as to what you can invest in. Now, it's very hard to say which approach to managing your superannuation is going to outperform. And realistically, no one can answer this question. If someone does tell you that one thing outperforms over another, then they're probably talking smack and you should be a little bit wary of that. But what you should be asking yourself is, am I comfortable with my investments? Because at the end of the day, you need to take a little bit of ownership of your superannuation fund. You need to understand what they're invested in. You need to be comfortable with how they're invested. And if you can tick that box, then for me, that means that you're on the right track. This one is an obvious one. Fees. The less you pay in fees, the more you're gonna have at retirement. So when looking at fees for superannuation funds, there's basically two types of fees that you gotta be aware of. There's the platform fees, which is what the actual superannuation fund charges you, things like administration fees. And then there's the investment fee, which is gonna be dependent on the investment option that you hold within your super fund. Generally speaking, industry super funds are gonna have the lowest fees. They operate on a not-for-profit basis, they do it on a very large scale and pool member benefits, and this allows them to provide a very low-cost option, particularly for small superannuation balances. As you start to move into platforms which give you a wider investment array and allow you to take a more bespoke approach to managing your investments and provide that additional reporting on your money, well then you can expect to pay a higher fee for this. Fees really is an area where people spend the most time and attention, and a lot of people base their superannuation fund decision solely on fees. And that's because it's easily understood, and often it's marketed to us through media platforms that the lowest fee paying fund will give you the highest balance in retirement. And that's not always the case, because remember that fees is just one component of the formula that makes up your final retirement balance. So while fees are very important, and yes, you should try and minimize your fees where possible, just remember that it is only one component and there's a lot more in this big picture. Insurance premiums are going to detract from your retirement nest egg. But as I've said in the past, don't get caught up with which super fund has the lowest insurance premiums. Most super funds will have a default insurer that they work with, but don't forget that you have the ability to shop your insurance around to try and find the most competitive premium. The only difference is how that premium is funded from your super fund. If you use the super fund's default insurer, then the premium's going to come out as a fund expense. If you use an external insurer, then the premium can get funded via a rollover from your superannuation fund. So I've done a video on this in the past which explains it in detail, and if you're interested in that, I'll link it in the description box below. Finally, we get to tax, and you're probably thinking that tax is the same amongst all superannuation funds because there's a legislated tax rate of 15% within the super accumulation phase. And of course, you're right, but there's a little bit more to it. There are a few areas where super funds can differ with regards to tax, and one of those areas is with franking credits. Now, if you're not aware of what a franking credit is, it's basically just a rebate of tax that you sometimes get with dividends from Australian listed companies. And so if your super fund is invested in a lot of high dividend paying ASX listed stocks, then there's a good chance you're going to get franking credits. And those franking credits can be used to reduce the amount of tax you pay within your super fund. There can also be a significant tax saving when transitioning from accumulation phase to pension phase. The reason being is that some superannuation funds will actually sell down your assets in accumulation phase and transfer cash to pension phase, whereas other super funds will actually transition the assets smoothly into pension phase. And the benefit of this is that if you're in pension phase, it's a 0% tax entity. So if you get to transition assets into pension phase, you can sell them down in pension phase and mitigate all of the capital gains tax that you've accrued up to that date. And finally, we again have untaxed superannuation funds. So think GESB Weststate Super again. And with an untaxed superannuation fund, as the name suggests, it's untaxed. The tax doesn't get taken out when the contributions go into the fund. It actually gets taken out when you exit the fund. And the benefit of this is that you get to earn investment returns on that tax money before it's paid. Now, the downside, or not so much a downside, but something you have to take into consideration is that your retirement balance, when you look at your statement, is going to be overstated because it contains a big whack of tax that you need to pay. So don't go relying on the full balance of an untaxed superannuation fund. Always remember that you have to take tax into consideration. So if you made it this far, then good on you. But you probably started watching this video in the hopes that I'm just gonna drop the name of the one best super fund out there that you should put your money with. But unfortunately, it's just not that easy because it's not one size fits all when it comes to super funds. But hopefully after watching this, you have a little more understanding of how superannuation works, what makes up components that dictate what the best super fund is for you. You can do a little bit more research and make up your own mind. But thank you very much for watching, and if you did like this video or if you did learn something new, then please give it a thumbs up, and I will see you guys in the next one.